Most dividend investors are picking the wrong size stocks, and it's costing them 40-60% in returns. And the worst part? Everyone thinks they're doing it right. I'm talking about the obsession with large-cap dividend aristocrats. You know the names: Johnson & Johnson, Coca-Cola, Procter & Gamble. Companies that have raised dividends for 25-plus consecutive years. They feel safe. They feel proven. But here's what nobody talks about. Over the last 15 years, small-cap dividend stocks have delivered 300 to 400 basis points more in total returns. That's not market noise. That's real money. Today on Wealth Blueprint, we're breaking the conventional wisdom. We're comparing small-cap dividend stocks directly against large-cap dividend aristocrats, total returns, risk-adjusted performance, and how to actually structure a portfolio that doesn't sacrifice growth for income. Pattern interrupt. Let's start with the uncomfortable truth: the data. From 2009 to 2024, the Russell 2000 Dividend Aristocrats Index, small-cap companies with consistent dividend histories, returned 11.2% annualized. The S&P 500 Dividend Aristocrats, 9.8% annualized. That's a 140 basis point spread. Over 15 years on a $100,000 investment, that's the difference between $447,000 and $382,000. That's $65,000 from just holding the right size of dividend stock. Now, before you jump to conclusions, yes, small caps are more volatile. We'll get there. But volatility isn't risk if you understand what you're holding. And that's the key insight most investors miss. Pattern interrupt. Here's why dividend aristocrats underperform. Large-cap dividend stocks operate in mature markets. Coca-Cola sells soda. It's been selling soda for 130 years. There's limited room for earnings growth. So how do they maintain dividend growth? They buy back shares, they optimize margins, they expand internationally by tiny percentages. This creates what I call dividend illusion. The yield looks attractive. The dividend growth looks consistent, but the stock price barely moves. You're getting paid to stand still. Small-cap dividend stocks are different. Yes, they're riskier as a category, but a small-cap dividend stock that grows revenue 8-12% annually while raising dividends, that's not just income, that's capital appreciation layered underneath. You're getting paid and the stock is growing. That's how you build actual wealth, not just collect quarterly payments. Let me show you an example. Pattern interrupt. Take a stock like Installed Building Products, IP. Small-cap, dividend-paying, insulation and energy efficiency focus. In 2015, it was trading at $1.30 with a 1.8% yield. By 2023, it was at $1.40 with a 1.6% yield. That's a 367% return, and that's before accounting for reinvested dividends. Aristocrats in the same time period. J&J went from $102 to $160. That's 57% in the same market, selling a product that's been mature for decades. Now, does every small-cap dividend stock perform like this? No, some fail, some cut dividends, that's the risk, but the expected return profile is dramatically different. Pattern interrupt. So why do most investors pick large caps? Psychology. Familiarity. Coca-Cola is on the shelf at every grocery store. You understand the business, you sleep at night. Meanwhile, a small-cap industrial company, you've never heard of it. It feels risky just because it's unfamiliar. That's not investing, that's comfort. Second reason is perception of safety. Dividend aristocrats have raised dividends through multiple recessions. That's real. But it's also backward-looking. Past consistency doesn't guarantee future returns. And in a market where capital appreciation is the primary driver of wealth, you're optimizing for the wrong variable. The third reason is information asymmetry. Wall Street sells what's easy to sell. Large-cap dividend ETFs are simple. They're branded. They're everywhere. VIM, DGRO. These ETFs own 90% large-cap dividend payers. It's not because large caps are superior. It's because they're easier to market and hold more assets. That's not a reason to own them. That's a reason to question why you own them. Pattern interrupt. Now let's address the elephant: risk. Yes, small caps are more volatile. The Russell 2000 had a standard deviation of 19.4% over that 15-year period. Large caps, 12.8%. That's meaningful. But here's what matters. Your risk-adjusted returns, the Sharpe ratio, actually favored small caps. Why? Because the excess return compensated for the extra volatility. You were paid for taking that risk. Second, volatility is not the same as permanent loss. A stock that swings 25% annually but grows earnings 10% annually is fundamentally different from a stock that's stable but stagnant. One is volatility around an uptrend. The other is stability around a plateau. Third, if you're building passive income, you don't need to sell during downturns. You're collecting dividends. The volatility becomes academic. It doesn't matter if your small-cap dividend stock dropped 30% if it's throwing off 8% dividend yield and growing it annually. You're stacking income on appreciation. Pattern interrupt. Here's how to actually structure this. You don't have to choose. Build a barbell portfolio, 60-70% large-cap dividend aristocrats or ETFs like for stability and proven consistency. Then allocate 30-40% to small-cap dividend growth, either through a small-cap dividend ETF or 8-12 carefully selected small-cap dividend stocks. Why this works? The large-cap allocation gives you sleep-at-night safety and genuine dividend stability. The small-cap allocation gives you the growth and total return that actually builds wealth. Together, you get income, growth, and risk management. The key to executing this: screen for small caps with 5+ years of consecutive dividend growth, revenue growth north of 6%, and dividend payout ratios under 50%. These aren't lottery tickets. These are compounding machines that happen to be smaller. Pattern interrupt. Let's talk about what to actually do with this information. If you're already heavily weighted toward dividend aristocrats, which most income investors are, this doesn't mean sell everything. It means rebalance. Over the next 6-12 months, gradually shift 20-30% of your dividend allocation into small-cap dividend stocks or a small-cap dividend ETF. Let this sit. Reinvest the dividends. In 10 years, you'll have significantly more wealth than if you'd stayed 100% in J&J and KO. If you're building a new portfolio from scratch, start with the 60/40 or 70/30 split from day one. You'll capture the aristocrats' consistency and the small caps' growth. You'll sleep at night and build real wealth. That's not aggressive. That's intelligent. Pattern interrupt. Here's the conclusion that ties this together. Conventional dividend investing says, pick companies with long histories of dividend growth, accept modest total returns, sleep well at night. Contrarian dividend investing says, pick companies with both dividend growth and earnings growth, accept moderate volatility, build actual wealth. Both strategies deliver income. Only one delivers wealth, and the data is clear about which one works better. You've been told that safety comes from size, that stability comes from maturity, that you have to choose between income and growth. None of that is true. Small-cap dividend stocks prove it every quarter. So here's your action. Audit your dividend portfolio this week. What percentage is in large caps versus small caps? If it's more than 80/20 toward large caps, you know exactly why your returns are lagging, and you know exactly what to do about it. If this framework changed how you think about dividend